Good morning, everyone, and welcome to Morning Markets here at True Potential. So a day of US equity underperformance led by Tesla. Last week, recall that colleagues updated on the Netflix earnings and the outlook, which led to a sharp fall in the share price there, pulling down the asset values of the technology sector. The update from Elon Musk with regards to the Twitter purchase on Monday has led to shareholders of Tesla worrying that Elon Musk may be forced to sell some of his existing Tesla holding in the future to help fund the considerable leverage required for the Twitter buyout. And that has helped exacerbate the weakness in the broader US technology sector, where around 70% of technology firms are now down around about 20% over the last 12 months. And part of this weakness in broader US equity markets can perhaps be explained by the continued appreciation in the US dollar. But this reflects the stronger growth profile of the US economy with regards to both Europe and China. China, of course, remains in severe lockdowns, and Europe faces growth headwinds from the conflict within Ukraine and Russia and the effect that that has had on energy prices. So we've seen particular weakness in currency markets in sterling versus the US dollar, but conversely this has had the effect of helping UK equities outperform. So recall that the FTSE 100 is a more outward-looking, a more global index. A lot of the revenue streams for UK corporations are from abroad, and sterling weakness helps support that revenue profile, and so you'll see that UK equities outperformed US markets quite considerably. Now, when we mention the US growth profile, we should add some data to help reflect that. So yesterday we saw durable goods orders updates, and this continues to show strong investment intentions from US corporations, where spending on goods exceeds implied inflation pressures. So this capital investment should help support US growth going forward, is very encouraging. We also saw revisions to US house prices for the month of February, which are now closer to rising 20% year on year. Again, very encouraging, and supports the updates from colleagues previously that the US household balance sheets are in good shape and that the US consumer remains robust. But we should expect some normalisation in these US house prices going forward, particularly given the spike in US mortgage costs over the last 4 months. But this is all normal. And just to end, given the equity weakness we've seen, particularly in the US, we're actually now seeing a more typical correlation with bond markets. That is, yields and bonds have begun to fall and delivered positive returns to multi-asset diversified global portfolios. And this is encouraging. It perhaps reflects that bond markets now are more comfortable with the expectations and the pricing in the markets. That is, aggressive hikes expected from both the Bank of England this year and the US Federal Reserve. And we hope that that should allow bond markets to be less volatile than they were in the previous quarter and to offset any future weakness from US equities. So we'll leave it there from now, where colleagues will update you later in the week on US GDP. Take care.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.